All eyes are going to be on the Fed meeting this week. Most traders are going to be focusing on the reactions in the bond market and the stock market. However, we suspect the commodity markets are going to make a sizable move as well. Don't forget, commodity prices are highly influenced by action in the currency markets, which will undoubtedly have something to say about this week's Fed meeting. It's widely expected that the Fed won't take any action this week, but the Fed Fund futures markets, which trade on the CME, the Chicago Mercantile Exchange, are pricing in 3 rate cuts by December of 2019. This is an exact opposite scenario of what we were talking about in late December 2018, in which the market was looking for 3 or 4 rate hikes in 2019. It's now clear that in December of 2018, the market was absolutely wrong about 3 or 4 interest rate hikes in 2019. But now, fast forward to mid-2019 and the market's predicting rate cuts, we have to wonder if the market's wrong again. Don't forget, the Fed Funds futures market is comprised of speculators, and speculators are buying and selling based on their opinions on where the Fed's next move might be. They can be wrong, just like any other market can be wrong. Aside from our opinion on what the Fed might do next, looking at a chart of the Fed Fund futures market, it's apparent that the market's a little overbought. Technical indicators are in overbought territory, such as the RSI, the Williams percent R, and we also see that prices went parabolic for about a week and a half in late May, early June. At some point, this has to correct itself. That's just how markets work. In our view, we wouldn't be shocked to see the market come down to some sort of a reality in between here and there. So, for example, if the Fed decides to cut rates only one time, we should see the Fed Fund futures market drift back into the 97.75 area to the 97.70 area. This would be an implied rate of about 2.25% for overnight Fed funds. The current market price is pricing in an overnight rate of about 1.75%. We've also noticed a correlation over the last several months. When interest rate products move higher and interest rates move lower, commodities tend to dribble lower. Further, the euro currency tends to dribble lower, and we've noticed a high correlation between commodity prices and the euro. So with all of that said, we believe if the Fed indicates that they're not going to cut rates 3-4 times throughout the next 6 months to a year, we believe the commodity markets will find stability and begin moving their way higher. Looking at a weekly chart of the Bloomberg Commodity Index, we can see that commodities in general are really, really cheap. In fact, if you really want to compare stocks to commodities, we're probably sitting in an environment in which stocks are the most expensive they've ever been relative to commodities, and vice versa. Commodities are probably the cheapest they've ever been relative to stocks. At some point, this has to correct itself, and it could mean both markets coming together, stocks lower or commodities higher, or it could just mean at some point commodities need to catch up with stocks. At this point, we're going to focus on the commodity market, and we see using the Bloomberg Commodity Index, which represents about 22 futures contracts in about 7 different sectors. So this covers the meats, the grains, the energies, metals, just about any commodity you could imagine, the softs even. We can see that commodities are basically sitting on support, trendline support, and they're the lowest they've been in quite some time. We were a little lower in early 2016. But aside from that, commodities really haven't been much lower than where we are now, and we're within a stone's throw of that range. On the flip side is dating back to 2014, this index was trading around 140. So with the Bloomberg Commodity Index at 77 to 80, with a recent high of 140, we're roughly half the value that we were in 2014. Now, we all know that simply being cheap isn't necessarily a reason for the market to turn around, but at some point, the cure for low prices in commodities is low prices. End users and producers of those commodities begin to change behaviors, and that changes the supply and demand dynamic. Further, if we see the U.S. dollar weaken and the euro strengthen, that alone, all else being equal, will push commodities higher. In our view, we wouldn't be shocked to see the Bloomberg Commodity Index trade back into the low 90s, specifically 94. That represents the trading channel that we've been in for several years, or well, at least the last 3 or 4 years. In short, if you've got the patience and the risk tolerance, now might be a good time to consider playing the upside in commodities.